It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Doing what we can to manage your financial future. Welcome back to the podcast. This is fun. This is good stuff. Second week in a row, Professor Plum, you and I are back in the same studios.
Yes.
Yeah, I think we're going to make a habit of this. In spite of the fact that, both of us probably could use some chewing gum once in a while or breath mint. But other than that, I think it's okay.
Well, thankfully, we have the 6 feet between us, so that helps that
Yes,
issue.
But as we said before, I think we always kept at least 6 feet for that very issue anyway. So we are here, and thank you all for joining us once again. I talked last week, had some really positive response, interestingly. I was mentioning my wife, who just decided, we kind of decided over the last few months, but she was going to hang it up.
Well, she's going to hang it up from the career she currently is in, which is very stressful, time-consuming, and she wants to maybe do something different.
Do something different. And the different thing she wants to do for about a year is nothing.
No work-related
No
issue.
work-related, no. Maybe volunteer, but not do any of that. And it related to two things. One of them we're going to talk about here in a second, but one was the fact that if we'd actually bothered to go over our finances a little bit more carefully, we figured she had to work till she was 65 because that's what we were used to.
Making the big bucks like she's been doing.
Yeah, I mean, it's not huge bucks, but it's good. And
when you work 7 days a week, 20 hours a day, you only sleep 2 or 3 hours a day.
Man, you know what? She should be paid twice, but what she's making, I think, for that. But anyway,
that's probably why she's quitting.
that's a very good reason. But we found, hey, you know what? We can actually make it. And one of the reasons had to do with what I'm going to talk about here with you. I've got 3 things, three generous tax law benefits that you didn't know about. Now you know about it, and I know about it, but that's because we talk about it. You, of course, are Professor Plum.
Well, yes, I am.
Yes, you're the advisor of the two of us.
Yes.
I am the host. I'm the podcast moderator. I'm not an advisor, but I pick up on all this knowledge, and I think it's a lot of fun to know and to talk about things like this. And sometimes we talk about things that are really cool that people had no idea existed.
It comes as a surprise, which we talk about it so often. It seems everyday commonplace to us, and we forget that it's not everyday commonplace.
That people don't know about it. And when we tell them about it, they say, really? So this made me think of this. And
or they get mad. You say, you can't do that.
You've had that too. Nuh-uh is the official response is nuh-uh.
Uh-huh.
Nuh-uh. Yeah. So I was talking about my wife who's semi-retiring or whatever you want to call it. Changing careers or taking time off. And I was talking to a couple of people on two different occasions. So they weren't all together. And I mentioned, well, we may be able to
bridge the gap.
Yeah, bridge the gap a little bit and tap some into the 403B if we have to. We'll see where it goes. And they both said, well, wait a minute. Now, I understand that
She's not old enough.
She's not old enough because I know from personal experience that if you're younger than age 59 and a half, you are penalized for taking money out of your retirement accounts, your IRAs, traditional IRAs, and all that stuff. So, I mean, you're going to pay a penalty and a tax? Aha. So I explained what we're going to be talking about is one of the first things that people probably don't know about, or many people don't know about. Professor Plum, let's get into this first one here. And that has to do with tapping into your 401k or other company-sponsored retirement accounts before you turn age 59 and a half without a penalty.
Right. Now, this only applies to the company that you're currently working for or recently worked for. If you terminate employment in the year that you turn 55 or later, you can tap into that company's 401k plan, profit sharing plan, whatever plan, without a penalty and take a distribution. Now, that distribution obviously will be taxable to you.
Yep.
But the 59 and a half rule, there is an exception. So if you want to retire at 55, 56, 57, 58, and all of your money is in tax-deferred retirement accounts, and at least some of the money is in the tax-deferred retirement account that is with that employer that you just left at age 55 or later, you can tap into that employer's or that previous employer's 401k plan or retirement plan.
Yeah, and I know we did talk a little bit about it last week, and we may be repeating, but I think it's important to bring this up just as a point of emphasis.
Now, this doesn't mean that I can retire at 52 and wait until the year I turn 55 to start taking distributions. That's not the key. The key is that I terminated or you terminated employment in the year that you turn 55 or later.
Yeah.
Not that you're waited to tap into it until 55 or later.
No. So in my wife's case, she's been with the district for 30 years or whatever with a pension plan and 401k. In this case, it's been the 403b since, for at least 20-something years. So this was her only real employer since she was in her 20s. So she is over 55.
And she's under 59 and a half.
And she is under 59 and a half. I won't give the exact age because people get upset, but you can figure out somewhere in there.
He wants to be able to go home and sleep with both eyes closed tonight.
It's funny. She actually, I told her last week, I said, you're going to listen to the podcast and I'm going to kind of mention your age. Whatever. It's fine. I'm just happy. I don't have to worry about this stuff. She is post age 55, and since it's her only 403b,
and it's with her current employer where she's currently working, she's going to retire later, a couple months from now.
Yes,
she will be able to access that. Yeah, and she'll be able to call in and say, "Send me a check for X amount of dollars." Mm-hmm. That X amount will be taxable, but it will not be penalized because of this exception to the 59.5 rule. Now, if this were an IRA, nope. No exception there. If it were a previous employer's 401k retirement plan, whatever, nope, no exception there. But because it's her current employer and the termination is going to happen in the year that she turns 55 or later, exception to the 10% premature distribution penalty.
Now, if you've ever in the past rolled funds into that 403b or 401k or whatever, that doesn't matter. Now they're all part of that.
It depends on how they account for it. In your case, it's not going to matter.
We haven't done it, but no.
I've seen where they segregate and keep them separate.
Oh, interesting.
As rollover money from previous. And
so you couldn't tap into the rollover money. That's interesting.
But that's unusual.
Now, it doesn't matter why you left the employment.
Yeah, they could fire you for that matter.
Sure. They could fire you with cause. They could, whatever, as long as you left, or you could leave on your own accord, whatever it is.
Right, but this has been a planning concept that we've had for many, many years that we've employed for people that are trying to retire before 59 and a half, who don't want to do a substantial equal payment plan from their IRAs, which can be a problem, especially with today's low interest rates.
Oh, yeah.
Can't get much out of that. 72T is what I'm talking about. And so this is a way you identify how much money you might need. And if you say, well, I think I might need $20,000 a year from 55 to 60. Okay, so easy math says 20,000 times 5. Get my toes out here. I need to put at least put 100,000. Now, I would say if you think you're going to need 20, build in some cushion there. Make it 30 just in case you want to get some more money out and you run out of money before you turn 59 and a half.
Yeah.
So, but leave it in the 401k, the 457 you can get out at any time, the 403b from that employer, and bridge that gap so that if you have enough money, it just is all in tax deferred accounts. And you have this availability of a current employer's plan that you're terminating from post 55, or I should say the year you turn 55. And that's the entry. I know people that are doing this at age 54. They turn
55 at the end of December.
Yeah, they're 54 in December 23rd, and they retire in January of the following year, the year they turn 55, even though they're 54 for 11 plus months.
And you could take it out at age 54, as long as it happened in that year.
Yeah.
Now, the custodian or whatever, the broker is going to say, hey, they took money out, it's taxable. Where do you make note that you left your employer?
Well, the employer should. There's a box that has codes in it, box 7, and usually the code is either box 2 for early or box 7 or code 7 for normal distribution. This one should be, I believe, code 1 that says an exception to the 10% penalty applies.
That's on the W-2
It's on the 1099-R.
On the 1099 that they send you. Okay, yeah. So it should be on there.
It should be. Now, if it's not on there, if your employer, for whatever reason, if you've got a good size employer, it's probably going to be done correctly. If you've got a very small employer with a mom and pop doing the bookkeeping and sending out the 1099s, they may do it incorrectly. You can either try to get them to do a corrected one, or you can just file the form with your tax return 5329 that says the exception is this. And
so you should at least make sure that that's done.
Well, if you don't, what's going to happen is if you get a 1099 that incorrectly, or for whatever reason, says that it's an early distribution, no known exception, the IRS their computers very quickly pick that up, and you'll in a year or two get a nice little nastygram from the U.S. Treasury.
Where's your 10% penalty?
And saying you took a distribution and you did not have a penalty. And while you can easily rectify the situation by sending in the appropriate form and saying, I was 55 when I terminated, yada, yada, yada. When you get that letter from the U.S. Treasury, it's still, it just makes your heart skip.
It takes your breath away, does it not?
And even if you know 100% you've done everything right, it still gives your heart a flutter.
That's right. So anyway, that was one of the things. We'll talk about audits too in a future. That's going to be another thing we're going to get into. But that's one of the things that you may not have known.
Yeah. Now, not everybody's in the position where they can use this, but it happens.
There. Sure.
And it happens also. We saw it happen last year where people got laid off. Now, they got opened up the availability to retirement money last year a lot more than normal, but we see people that get laid off later in life, before 60, after 55, and they need some money to bridge the gap. And this can help.
It absolutely can help, and it's been on the books for a long time. It's nothing new. Okay, so that's one of the tax law benefits that you didn't know existed. Many of you do.
You might not have known.
Many of you do not. May not have known. It's catchier to say that you didn't know they existed. Here's another one for you, and I think you get this question from time to time, Professor Plum, because we talk about this so-called 0% tax bracket. So the second tax law benefit you didn't know existed was, I wrote it down here, there's a 0% tax bracket. Or is there?
Well, technically, no. I mean, and I've had people say, you know what? I looked up the tax brackets, and the tax bracket starts at 10%. My taxable income 0 to 19,000 and change says 10%. There is no 0% tax bracket. And you know what? You are 100% correct. Technically, there is no 0% tax bracket.
Officially, there's no 0%.
Once we've calculated the taxable income, you apply a tax rate to every one of those dollars. But there is a zone before you get to the taxable income. This is all about semantics, terminology, whatever you want to call it. There is adjusted gross income. There's your gross income. There's your adjusted gross income. And then there is your taxable income. And between the adjusted gross income and the taxable income, there's one of two things. There's either a standard deduction or your itemized deductions. And you get to reduce your adjusted gross income by that amount. And in essence, you get to say, I am not going to pay any taxes on this first block of money.
Let's say let's use the standard deduction, because that's what most people do. Let's take it in terms of that, a married couple.
Married filing jointly, they between the two of them, they have a total income of $100,000. Total.
That's everything.
So they say, I make $100,000, and we're not doing any 401ks, or so we're not doing any deductions anywhere. We're just talking about our gross income is $100,000, married filing joint return, and oh man, what are we going to owe in taxes? So they go to the IRS website or any other, and they type in, they Google tax brackets for 2021, and they get up and it says 0 to 19,000 and change, 10%. 19,000 and change to 80,000 something. I can't remember the numbers exactly. 12%. Above 80,500, 22%. They're like, crud. We're in the 22% income tax bracket. So we calculate the tax on the first 19,000, tax on the next block, and then we're paying 22% of the last $20,000 of our income. But they mistook the semantics of the term. They took their gross income and applied the tax brackets to it. You get to reduce your gross income by an amount equal to the standard deduction, which is just over $25,000 this year.
That's for a married couple.
For a married couple.
Yeah, it's I guess half that for a single.
Right.
Yeah.
And so I take my $100,000 of gross income and reduce it by the standard deduction of $25,100, and I come up with $74,900. So my taxable income is $74,900. Not only is that not in the 22% tax bracket because it's under the $80,000 level, I got a little bit of room left in the 12. So now I can actually calculate my tax. But the first X amount of dollars. And X depends on whether you're married, filing jointly, married, filing separately, single, or had a household. And there's different numbers for those. But there is a block of income that you do not have to pay tax on.
So could a person theoretically make $24,900 or $25,000 gross income. As a married couple, they could have a $25,000 income gross and pay no taxes?
Yes. Oh, very easily. You could have a higher than that income and pay no taxes.
Yeah.
When you say, well, I've got Social Security of $30,000 and I've got other income of say $10,000 or $12,000, maybe $15,000. And even though my gross income is way over $25,000 at that point, you still don't owe any taxes because before you get to that gross income doesn't mean add up every dime of income you have. Unfortunately, it's not that simple. The tax code can't let anything be that simple.
No, but it could be in your favor because of that.
Oh, it's very much so. And it depends on where your income's coming. I may have a salary. My salary may be $100,000 a year. That's what they're going to pay me for the year. But out of that salary, I defer my $19,500 or my $26,000 into my 401k, which I'm allowed to depending on age. I pay $500 a month for my health care pre-tax. Those numbers come off the top. They don't even show up on the tax return anywhere. Only the net number of that shows up on the tax return. So my $100,000 turns into about $70,000 or some number. So is it really my gross income? Well, it is on your tax return.
And that's what matters. So in essence, you have, although you said not officially, there is not an official 0% tax bracket.
When you look at the brackets, there is no zero bracket, but there is a block of money where you do not pay taxes. And that's what we call the zero bracket.
That's right. And it comes from, as you said, your standard deduction or your itemized, in some cases, that 25
If your itemized deductions are higher than your standard deduction, you can take the higher of the two.
Does the standard deduction increase for somebody who's over or who's 65?
Yes. If you're blind or 65, you get an additional standard deduction. How much depends on whether you're single or whether you're married.
Yeah, and they raised that standard deduction by quite a bit a few years ago.
Well, they raise it every year with cost of living.
But I mean, it jumped up. I thought it jumped up quite a bit when they got rid of the personal exemption, which I'm still fighting to get back.
Well, the overall effect was better. The standard deduction used to be 12. And then you got like 8 for a married couple,
yes.
two $4,000 personal exemptions. So you got $20,000 of deduction. And then they raised it to $23,000 they got rid of the personal exemptions and raised it to another number.
Didn't help for itemized people.
Well,
people who itemize.
Yeah, well,
we used to be able to take all the itemized, and we got the personal exemption. So
for the other thing that hurt the itemized filers were people that live in high tax states.
Yeah.
Was the SALT, the state and local income tax.
As I understand it, they're looking at repealing
that portion of it.
That portion, yeah. So we're hopeful that will go away. Anyway, so the two things that we've mentioned so far that you did not know about, well, maybe you did, but worth bringing it up, was that you can tap your 401k potentially
before 59 and a half
without penalty.
As long as you terminate employment at age 55 or later, you have access to that company's plan.
That's the first one. The second one was that there is a 0% tax bracket unofficially, but for all intents and purposes.
Hey, there's a block of money I don't have to pay tax on.
And that, to me, tells me that there's a 0%. Not officially, but it is there. And the third generous tax law benefit that you didn't know existed, and again, this is one of the things we've talked about, but let's bring it up, has to do with selling your primary residence. Now, I mean, where we are right now, for the day that you and I are speaking, try to keep your house on the market for more than 24 hours. I mean, at least where we are, where I live, where you live in our state, I mean, it is a seller's market like you wouldn't believe. So there are a lot of people, I think, that are taking advantage of this, and they're selling their home. But there are some people who say, I don't want to sell it because I've owned it for so long, and I don't want to get taxed. Professor Plum, you can sell your primary residence and pocket a certain amount of the gain tax-free.
Right, and it's a lot of people say that they don't want to do it because they've already done this once and they can't do it again.
Yeah,
that is not true either.
Yeah.
So basically, what the rules state now are that, and this has been in place since 1998, the first $250,000 of gain per owner on the sale of a primary residence that I've owned as my primary residence for at least 2 years and lived in it for at least 2 years as my primary residence, I can avoid the tax on $250,000 per owner. Married couple, 2 owners presumably,
Yeah.
You got $500,000 of gain. So if I paid $200,000 for it 15 years ago, and I'm now selling it for $700,000. Now that $700,000 is net of selling expense.
Yeah.
And so, the realtor fees and things like that, come off the top. It does not involve the mortgage. The mortgage is not an issue when we're calculating this. I paid $200,000 for it 15 years ago, and then I've refinanced it 14 times.
And took cash out.
I owe $600,000 on it today. I'm selling it for $700,000. The gain is not 100 in that case. The mortgage has nothing to do with the gain.
Yeah.
So anyway, I sell it for $200,000. I bought it for $200,000. I didn't do any improvements. I'm a lazy bum for 15 years, and then I sell it for $700 net of selling expenses. Married couple, tax free, zero tax, $500,000. So you take the 700 minus the 500 brings me down to a net sale for tax purposes of $200,000. My basis is $200,000. Zero income tax, zero capital gain tax.
Yeah, and that's a change from where it was prior to 1998, because if you were under, I think it was 55, you had 2 years. Was it 2 years?
2 years.
2 years. You could sell your home, and you had 2 years
to buy an equal or greater value home.
Yes, use those funds. Otherwise, they were taxed.
Right. Otherwise, it was taxed. This is just capital gain.
A normal capital gains tax.
Either short term or long term, depending how long you hold.
And then if you were over 55, you could move down one time.
Equal to or less than one time up to 125 of gain.
Yeah. Now
they expanded it dramatically in 1998, thanks to some campaign pledges that for the presidency.
Gotta love those. You gotta love those congressional election years and the presidential election years, because we got both presidential candidates who jumped on that.
Right. One said one thing, the other said, "Well, let's double it."
Let's double it. That's right.
And so, but it's been around since then. Now there have been some changes to the law. Now you can do this as many times as you want, as long as you don't take the credit, it is a credit. You don't take the exemption more than once in a 24-month period of time. So you can't sell multiple houses over time, in a 2-year period of time and take the exemption twice. Mm-hmm. As long as you've lived in the property for at least 2 years, as long as you've owned the property for at least 2 years, you could do this multiple times. Now, when it first came out, we had people who had a lot of rentals who would say, well, I'm going to live in this rental for 2 years, sell it, offset $500,000 again, live in this rental for 2 years, and just move from rental to rental to rental to rental. And every couple of years, they would sell one, and it
was great.
And they were getting all these capital gains, tax free. Well, Congress said, well, that's not exactly what we had.
You're getting more money than we intended for you to get.
This one I understand more than the other. This was not intended to help you get out of gains on investment properties. This was intended to let you keep your gains on your primary residence. So they put a new law in 2008 that said if you are doing this, hopscotching from one house to the other house, now we've got a new set of rules for somebody where the house was previously owned by you, but not as your primary residence.
Yeah, it's sort of complicated and has to do with how much
all you have to know.
it.
If you've owned the place as your primary residence for the whole time of ownership, not an issue.
Yeah.
But if you're moving into a home that you've owned, that was not always your primary residence, there may be a proration. There may be a reduction in the amount of gain you can take tax-free.
Is that true for people who have vacation homes?
Yep.
So it doesn't matter.
The terminology is primary residence or other.
Yeah. Okay. So if you had, you're wealthy and you had 3 vacation homes, if you move, you still can't go move into one for 2 years and then sell it totally.
I mean, there are ways that you can, depending on how much gain you have and things like that. But they're going to look at the time that you've owned it after 2008, that it was not your primary residence, and use that against you.
Yeah, it's a little bit convoluted, but for those few that are in.
But no, I know a lot of people that have vacation homes. They have their work home, and then they have an escape place, and when they retire, their escape place becomes their primary. They sell the big house in the city and get away from it all, and they moved into their vacation house.
I knew a guy who jokingly referred to it as his mistress home. I probably shouldn't say that, but that's horrible. But it was actually a vacation home. They joked about it, he and his wife. But that's they took away so many of this fun planning techniques,
And they will over time again. Things we think are fairly straightforward now, they'll mess it up again.
That's right. But anyway, so these are the three things, three generous tax law benefits that just from me looking around, people didn't know about them, so I thought we would bring them up today. 0% tax bracket, more or less. Taking money out of your 401k or 403, your company retirement plan before you turn age 59 and a half, penalty-free, at least age 55. And you can sell your primary residence and pocket the gains tax-free. Seems unheard of that you could do that. Now, anything over that gain, if I bought a home for $200,000, but I sold it for $1.2 million, so I have let's say I have $1 million gain. First $500,000
it's tax-free.
Is tax-free. The next $500,000
of gain is taxable, and there's no rollover capability with it.
No, so it's I guess depending on your income, what is it? What is the capital gains now?
Anywhere from 0 to 23.8%.
Yeah, the 23.8, you'd have to be making quite a bit of money.
Well, you get a $500,000 gain, you're going to hit it.
Well, that's true because they count the gain. That's true. You
even if that was the only thing you had.
For 1 year. Oh, that's right. Yeah, you would, wouldn't you?
Because, yeah.
Oh, my goodness. Anyway, just to understand how this works, that there are some cool things. And, hey, if you were looking to move but you're afraid of the gains because you've owned the home for 40 years...
Yeah, you paid $15,000 for it back in 1965.
Sure, absolutely, and that's not a bad home. You can sell it tax-free. So these are just some things that we've found that people don't necessarily know about, and things that we've talked about in the past. So I hope that was enlightening for you. I enjoy talking about things like this. I think maybe in the next, month or two, I'll try to see if we can get a few more hidden gems that a lot of people don't know about. Some of it has to do with gifting and all that stuff, but we could talk about this. Anyway, if you've got overall planning needs and you want to talk to our Professor Plum or any of the Lucia Capital Group advisors, there's a whole team of people that we work with here.
Of course.
We got a team.
I can't do it all.
No, you can't. You've tried, but you can't. We've got teams of advisors who do investing.
We have insurance annuity experts. We've got tax experts, Social Security people. I mean, people, we don't work for Social Security, but we know it maybe better than they.
Maybe. We're not allowed to say we do, but you know what I mean? Find out. Give them a call, 800-644-1150, the number at Lucia Capital Group. Work with the team. It is a team of advisors. You have an advisor yourself. It's a single point of contact that you don't have to contact 6 different people, but just know that your advisor is working with however many people are required.
We'll bring in whatever they need to, for the information.
Absolutely. I believe, personally, Professor, that I don't necessarily want my planner being the same person who is doing the investment analysis. Well,
the planner is usually on the phone in meetings all day. They don't have time to watch every aspect of the market. So you want an investment team behind you. Yeah, and I don't want the same person that I'm talking to about my Social Security, picking my stocks, because there just isn't enough time in the day to understand both areas.
No, it's nice to have somebody who spends their entire time doing that, which is why we have this particular team approach.
And frankly, those guys that do the investment, they're hard to talk to at times. They've got a different language all their own too. And so it's hard to understand them.
They're kind of nerdy, these folks.
They got the propeller heads,
They really are. But that's what you want. That's what you want.
They're not listening.
To heck with them. What are they going to do? Beat you up? Come on, these guys.
Take my lunch money?
Exactly, yeah. 800-644-1150. Or you can go online, of course, luciacap.com, LUCIACAP.com, and talk to either Professor or any one of the other advisors on the team. Professor Plum, I thank you so much. Next time we were talking about planning and using an advisor and things like that. I'd like to get into fees, because we get questions about people, and they should be asking about fees. How planners...
What am I paying for this? How
advisors get paid? How much do I have to pay and all that? So we're going to talk about that next time. Be sure to subscribe to our podcast. You won't miss a single minute of this. Once again, you can do all that at luciacap.com. For Professor Rick Plum, Certified Financial Planner Professional, I'm your host, podcast moderator, Johnny Dean. Talk to you again next time. Thanks so much for listening.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59 and a half, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.